Experts are frightening the hell out of everyone, and today we're going to talk about where interest rates are going, what we're seeing, and some information that might help you rest at night given all the craziness that's out there at the moment. So let's dive in and have a look at it from the top. So what's actually going on? Well, we're hearing a lot of news and a lot of talk in the market that rates are going to keep going up. Affordability is really a struggle at the moment. So we're going to look at some reasons why rates might not go as high as predicted. So this is some good information that we've seen recently. And I guess with a surge of everyday costs such as groceries and fresh food and a series of rate rises by the Reserve Bank, it's actually pushing up the cost of living by hundreds of dollars per month for the average Australian. Now, on the top of that all, with most experts you listen to, they'll actually tell you the worst is yet to come. And they're saying that there's going to be a lot more aggressive rate rises to happen. I guess looking at a couple of things, particularly with some basic principles that they've abandoned in their quest to, one, frighten the living hell out of everyone. And I guess really the main thing is we've got to look at it from a logical point of view. The first is that Australia is actually in a pretty vulnerable position from an economic downturn, especially with interest rates rising for a few reasons. So unlike the US, Australia and our households, we don't have fixed rate mortgages like the US, where once you get your loan, you're fixed in for the term of the loan. In Australia, most people are on variable rates, or even if they're on a fixed rate, they're relatively short in that regard. So every time there's a rate rise for the average household, they're feeling it. They're getting that knock-on effect straight away. So if you're on a $580,000 mortgage and you're paying that every month, you go from $2,400 per month to $2,600. There's $150 a month out of your budget. So straight away, we're feeling it more than probably other countries whereby they're locked in for longer periods of time. So as it says here, the movements are directly impacting Aussies more than other countries might be feeling. And to add that up, we've also got a huge debt. So Australian households are at the most indebted, and that's mostly driven through real estate. So they're geared through real estate, and these sort of rate hikes, put quite large pressures and will actually hit the property market quite hard and could potentially plunge us into a recession if left unchecked. And this would be a disaster and would also potentially see the Reserve Bank needing to reverse course. So they're being quite aggressive at the moment. There might be some negative impacts that we see as second and third order consequences that the RBA has yet to be really grapple and get their head around. And it goes on to say, well, the question is, does the Reserve Bank want to see everyone go broke? And I think the short answer to that is no. There are going to be marginal borrowers and marginal homes that are going to be left behind because of this Reserve Bank's aggressive hiking and pushing of interest rates up to try and curb inflation. However, they're going to have to get to a point where they're going to really think about their strategy. And I guess if we believe all the predictions out there, it's tipped that the cash rate could hit up to 3.5% by mid next year. Now, the cash rate at the moment with the Reserve Bank is 1.35%. So 1.35% to get to 3.5%, that's some serious increases that we might be seeing. Now, believe it or not, there's actually been a little bit of a scaling back. So a few weeks back, the money markets were actually tipping the official cash rate to hit 4%. Now they're talking 3.5%. What do you think is going to happen? Do you think they're going to scale back these predictions? We've seen a few banks actually say they don't see it getting past 2.6 or 2.3%. Be interesting to see how this actually plays out. Now, what will actually happen is there were predictions that mortgages would be priced up to 6% compared to where we were at a rock bottom under 2% as early as late last year. So that'll be a huge impact to households, because if you've gone from 2% to 6% in a very short period of time, that's an extra $1,500 a month you need to find out of your budget That for a lot of people is devastating to the month-to-month, day-to-days. Now, it also talks about the fact, and a lot of people got into the mortgage market last year because the Reserve Bank governor was saying we're not going to move rates until 2024. And we can see that, and just imagine what sort of impact that's going to have on the 165,000 first homeowners who bought real estate last year. It's going to have an enormous strain on them, and we could potentially see millions of household Australians having issues and also really struggling to meet their commitments. Now, as far as when we look at, people and their commitments and how they prioritize, we know that almost every Australian will do anything to ensure that they keep the roof over their head, and they'll cut on other areas of spending outside of their essentials to meet their mortgage commitments. That's all well and good, and it's worth remembering that about 60% of the economy and the growth of our economy comes from household spending. So as these rates rise and people move more to essentials, we're going to have a higher risk of moving to a recession because there's no spending. And if 60% of the economy is reliant on household spending, and that's really being cut up, we're going to find that things are going to move pretty drastically and quickly in a recessionary direction. And it also says that here, if spending falls off the cliff because of rapid fire interest rate rises, we'll tip into a recession. And then this will be a much bigger problem for the Reserve Bank and the governor and what he's got to do there. So I think there's a lot to keep in mind in what they're trying to do. Now, think about, I know my parents always said, back in my day, we paid 17% for interest rates and all this sort of stuff, but we're actually more vulnerable than we have ever been before. Back in 1994, the Reserve Bank jacked up rates viciously. In July that year till December, they jumped the official cash rate from 4.75% to 7.5%. Now, that was done in 3 steps, and they had 1% leaps. Now, can you imagine that today if we had a 1% hike, how crazy the markets would go and how much of an impact that would have on a lot of people? So what's actually changed? Have we become wimps? Absolutely not. That is not the case. The real change is in the value of the size and cost of real estate, which has an impact because people need to borrow higher loan amounts. So back in the 90s, the median price for a house in Sydney, which was the biggest, most expensive area in the country, was $169,000. Now, can you imagine a rate reduction or rate rise back then? You go on 169,000 loan, maybe you're paying 5% and it's jumped up to 10%. $500 increase still would have hurt the back pocket back then. Have a look at it nowadays. From 169,000 for a medium value of a property, jumped up to 1.25 million. That is just insanity. And you look at wage growths and how that's sort of correlated, and you can bet your bottom dollar that the value of mortgages have increased far greater speeds than the rate of change on wages and what they were getting paid back in the 90s. Now, this huge valuation jump has been funded by debt. And it's because we owe so much that the effects are actually magnified nowadays. If you compare debt to income ratio, we're vying for world domination, but not in a good way, in the sense that we've actually got some of the highest debt to income around the globe. And we're being compared to Switzerland, Netherlands, Denmark, Norway, and other countries that are in such high indebtedness. Now, this makes us very sensitive, hypersensitive to rate rises in the movements. And it means that the Reserve Bank doesn't have much leeway when it comes to interest rates, especially because they have such an effect on the everyday Australian. And it means they need to be very careful when they are looking at these rate rises. Now, one of the problems that the Reserve Bank has is inflation. So they're talking about the fact that, in their quest to get this inflation fixed, it's actually going to damage and cause issues to everyday Australians and across the economy. Now, there's 2 things they need to look at. And the 2 things that determined this dilemma, or it makes this a dilemma, is supply and demand. So the large problem is that we've seen prices increase for fuel, food, fertilizers, and manufacturing goods. Now, this isn't because of anything other than the fact that supply has been a problem because of the pandemic. So the tricky thing is for interest rates and for the central banks is that they have only got one lever to pull, and that's interest rates. And a lot of the time, the data they get is quite delayed. So if we look at inflation and other reportings that the Reserve Bank get, they're usually for only every quarter. So for every 3 months, they're flying blind because they're only getting that data once every 3 months. So 4 times a year, the Reserve Bank of Australia knows where we're at. And between then and there, they're actually just sort of flying by the wayside. They're sort of just trying to figure things out as they go. And, the tricky thing is when demand meets supply, then what will actually happen is we'll get a sort of situation where the elevated prices, such as, for example, it talks about carrots here, where the supply has been really reduced. It's driven up the cost of carrots and it's more than doubled. The way they measure inflation is they look at the increase. So if carrots have gone from $1 to $2, if the change doesn't, if there's no further increase in the cost of carrots from then, it's still elevated. The price is still higher, even if there's no inflation. And that still has an impact on the Australian budget because now carrots cost $2 where they used to cost $1. So it means that even once they get inflation in control, prices are still going to be elevated. So the fact that things aren't increasing so aggressively doesn't change the fact that it still costs a lot more than what it once did. So we've got to be careful. They talk about there's a delayed reaction when it comes to interest rates. And many economists call this a lag effect, which makes it difficult to judge how much of a pressure you need to apply to get the desired effect. So think of it like this. If you're in a car and you jam on the brakes and you have no reaction, then you push even harder only to find out you've locked the wheels and you're skidding off the road. That's fairly similar to what we see with the Reserve Bank governor and the data that they have. A lot of the stuff they have is delayed. They get the information after the fact when they made all these changes and they don't necessarily know if it's working or not. And we saw this having started late. The central banks are now in panic mode. America is pumping triple rate hikes. We've seen Australia do 2, New Zealand in the same boat. And there's no doubt that there was a need for these rates to go up. At 0% or close to 0%, money was free. So essentially that did need to happen. However, if we think in the last 5,000 years, it's really inconceivable to think that what we've seen in so low interest rates could actually happen. And these low interest rates have caused bubbles in assets such as real estate, stocks, and even imaginary things like NFTs and crypto and all that markets have all gone absolutely wild. So now that we're trying to unwind all this distortion of hugely high elevated price, it is a difficult process and quite painful, to be honest. So as we move towards that normalization, this sort of a thing, or normalization of interest rates as they call it, these sort of things should take years, possibly even decades, and should be done slowly. Where we're actually starting to see the central banks had recognized last year that this was something that they should do slowly, but temporarily they're jetting off. They've got a quest to snuff out inflation and they'll do whatever it takes. But I don't think they realize the consequences, or maybe they do realize the consequences and they're just going for it anyway. And they understand that maybe the marginal homeowners and borrowers are going to just be the collateral damage. I mean, what do you think? Do you think this is something that they're probably well aware of, the fact that jet setting with these crazy rate hikes month in, month out is going to have some unintended consequences? And I guess no one knows what normal is. The central banks, such as the RBA, look at what they think is the normal or neutral rate, but it's like Goldilocks. The level that they need to keep the economy growing, they need to find that right temperature just to get it right. Now, we might well see that the rates are moving at a blistering pace. We're seeing things increase, and that cash rate might well need to get to 3.5% to get to that neutral rate. But it is a dangerous course of action, and there's going to be a potential for it to backfire spectacularly. So slow rate hikes or to be forced to cut. At the start of last year, many monetary markets started going haywire and aggressively pricing rate hikes and inflation to begin to assert itself aggressively. We saw this with the banks. The banks were calling out the Reserve Bank governor at that stage, telling their economists were saying, we can't see interest rates on hold until 2024. We see it going up sooner. And back then, it was actually laughed off by most central banks, including our own. The Reserve Bank hammered home that interest rates wouldn't rise for years. Nothing to see. Everything's all good. We're all happy days. And a lot of borrowers took that advice in their actual assessment and making decisions that are actually having long-term impacts. Now we can see the Reserve Bank governors have a mad rush. They're trying to catch up with the markets, and they've slammed on the global brakes at a time when we're seeing China in a deep distress. We're seeing the short-term impacts of their zero COVID strategy collide with long-term issues and challenges. And we saw the IMF, the World Bank, the OECD all slash their forecasts on growth while saying that's a prospect of recession looming. So it's a lot of things going on here. We saw a fortnight ago, the money markets have also started to radically reassess their future and where they're sort of predicting rates to go. We saw that in the bond market where the three-year rate started to come down, three-year bond rate started to come down, and they're really scaling back where they probably saw interest rates might have been last 12 months to where they are now. And I think we're starting to see the penny is actually starting to drop, because as these rates drive in even harder and at a quicker pace, we actually might not find that it has much of an effect on inflation. So it might kill demand, but thereby unnecessarily creating a recession. And there has been many wake-up calls, and economists and experts around the globe probably need to take note and understand that, if we're obsessed with stamping out inflation, we're probably going to have more issues than what it's worth. And it leaves the Reserve Bank with two choices. One, start to dial back the speed of rate hikes and accept maybe inflation might be something that takes a bit longer to tame, or keep going hard and the economy goes into a recession and you're only going to have to start cutting rates at the end of next year. And that's what we've seen some of the predictions say, that rates might actually start to unwind next year, the second half of next year. I guess the destination's all the same. And what they're saying is next year, rates are likely to be lower than what many are predicting. Guys, what did you think? Leave a comment below. We'd love to hear your feedback. Also, let me know what you'd like us to talk about next. Here at Hunter Galloway, we're mortgage brokers. We're based in Brisbane, but we deal with people Australia-wide. So if you're living in Perth, Adelaide, Tasmania, we can help. We help first homeowners, owner-occupiers, upgrading, downgrading, and investors, people refinancing, looking to get equity out. Call us on 1300 088 065 or visit us at huntergalloway.com.au, and we'll see you next time.